Possibly the highest yielding dividend aristocrat stock out there right now is Walgreens Boots Alliance stock, ticker WBA, currently trading at $20.11 per share. We can see they currently have a starting dividend yield sitting over 9%. So those are massive dividend payments, and we can see over the past year down almost 50% and year to date down around 46%. So again, a massive starting dividend yield, and this is also a company that's been increasing their dividend payments for 47 consecutive years. So in this video, there's a couple of things that I want to touch on. First, we want to discuss on, is the dividend payment from Walgreens safe, and also is it trading at a good value? So let's go ahead and dig into it. Now, like I've already mentioned, Walgreens is a dividend aristocrat stock, so they have a rich history of increasing those dividend payments over time. If we look at the past 10 years, we can see they're paying out 28 cents per share every single quarter in 2013, and jump forward to now, 48 cents per share every single quarter. And if we look at those dividend growth rates, we can see they are pretty low dividend growth rates. We can see the 3 and 5 year dividend growth rates sitting at 1.25% and 2.71%, while the 10-year dividend growth rate somewhat decent, actually sitting at around 5%. Now, the big question that we need to go ahead and address is the current dividend payment safe? If we jump back over to the dividends and click on dividend yield, I'll scroll down and we can see the dividend yield is currently the highest it's been in over 10 years. When I click on this chart, we can see right now it's currently yielding a little over 9%, when historically speaking, it's been yielding anywhere from around 1 to 2 to 3%. So let's go ahead and touch on this dividend safety from a very surface level. I'll click on the dividend safety tab. Now, if we scroll down, the first payout ratios we'll look at are as a result of earnings per share. And we can see for trailing 12 months non-GAAP, the dividend payout ratio sitting at around 48.12% and forward-looking sitting at 58.65%. Now, if we come down further and look at the cash flow payout ratio forward-looking, it's sitting at 43.53%. So based off our first analysis, our first glance, it does appear that this dividend payment is safe, but we need to dig into this just a little bit deeper to get a better picture. So let's go ahead and start digging into the financial statements to get a better understanding of where Walgreens is at. Now, the first thing we could glance at is simply the revenue. We can see over the past decade, they have done a somewhat decent job of growing the revenue over time. Now, the question is, have their margins been good enough for this to find its way into the bottom line in net income? Well, if we come here and look at gross profit, we'll go ahead and see this charted out. While the revenue has increased, gross profit really hasn't increased hardly any for Walgreens over the past decade. Obviously not a good sign. So if we scroll down and look for net income, we can see right here, not only have they not really been able to increase their net income over the past 5 years, for the trailing 12 months, they've had negative net income, negative $3 billion, obviously a huge red flag for this company. So again, while we saw revenue per share increase by a pretty large amount, that did not find its way into the bottom line. That's a huge concern for me as an investor in this company. Now, if we scroll up, let's go ahead and move over to the balance sheet. We can see right here, cash and cash equivalents over the past decade has been steadily declining. Now, a lot of the times that is a red flag, but we don't know the whole picture yet, so we will give them a chance. Let's go ahead and see what's gone on with their total debt over the same time period. So I'll go ahead and scroll down, and we can see their long-term debt right here. It's absolutely skyrocketed, over doubled over the past decade. So combine the fact that they've had declining cash and cash equivalents and doubling long-term debt, obviously again, not something we want to see as an investor. So okay, that really doesn't tell us a whole lot about the dividend yet. Obviously those aren't good signs, but we need to keep digging into this a little bit more. So let's go ahead and jump over to the statement of cash flows. Now, we already touched on net income. We saw they do have negative $3 billion in net income for the trailing 12 months. Let's go ahead and keep scrolling down. And what I really want to look for is free cash flow per share. To me, this is the holy grail of metrics as a dividend investor and as an investor really in general. So if we come down here, we can see our free cash flow per share metric. Again, there's 5 different things that a company can do with free cash flow. It's really important you understand this. With free cash flow, a company can reinvest back into the business. This is pretty popular for high growth companies. They can pay out dividends, they can pay down total debt, they can buy back shares, and they can also attempt mergers and acquisitions. So all 5 of those are ways that a company can create value for shareholders. So obviously, again, free cash flow per share, extremely important metrics. Let's see what's gone on over the past decade. We can see they're sitting at about $2.92 in free cash flow per share over a decade ago, and it looks like they were able to increase it for around 5, 6, or 7 years. But if we look at the past couple of years, it has absolutely dropped off. In 2022, we saw $2.50 of free cash flow per share, the lowest it had been over the past decade. And for the trailing 12 months, we are currently sitting at 16 cents in free cash flow per share. So let me go ahead and paint this picture. If we go back over to the summary tab, I'll scroll down, we can see their dividend payout forward looking for the year is $1.92. That means in order for them to be able to pay out their dividends out of free cash flow, their free cash flow per share needs to be at least $1.92. And like we just saw, it's not anywhere close to that metric as of right now. I'll go ahead and scroll back down and we can see last year it was within that range, but right now they're not anywhere near being able to pay out their dividends from their free cash flow. So there's a couple of different options that they have. Obviously, they could pay it out of their cash position, but like we just saw when we saw the balance sheet, their cash position has been declining over the past decade, and it's pretty much the lowest it's been over the past decade. So it's pretty clear this company is in quite a bind as of right now. And if we jump over to this article I was just reading on Seeking Alpha, we can see one analyst is projecting that in 2024, Walgreens is expected to pay $1.95 in dividends. Meanwhile, its free cash flow per share sitting at around $2. So yes, while that is enough free cash flow to pay out their dividend, that's still a 98% payout ratio in 2024, which is dangerously high and obviously essentially leaves no free cash flow left over to do anything like reinvest back into the business or pay down debt, which is obviously a huge goal for the company as of right now. So my initial gut reaction after digging into the financial statements is no, I don't think this dividend is necessarily safe. And obviously as a dividend investor, I want to see growing dividend payments. And while a high dividend yield is fun to see, more importantly, I need my dividend payments to be safe. But it looks like in the case of Walgreens, although they are close to becoming a dividend king, it looks like it's in their best interest to consider cutting the dividend. Now, the question we need to answer still is it trading at a good value at $20.11? Has the risk of a dividend cut made this company undervalued? Well, to answer that question, we'll jump into my stock valuation spreadsheet where we'll look at a few different valuation models to better understand Walgreens stock. And like always, if you'd like to be able to download the spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. Now, okay, let's go ahead and come up here and plug in WBA and hit enter, and you can see all this data will automatically load in. Looking at a 365-day change chart, you can see just how dramatic the share price has fallen. Come over here, we can see obviously the over 9% starting dividend yield. Again, the payout ratio a little bit misleading, just like it was on Seeking Alpha, until you dig into those financial statements. If we come down here, we can see analysts have a target price of around $26.42. Institutional ownership really not that high at around 58% and a beta of just 0.79. So you shouldn't see a whole lot of volatility with this company. Now, the first valuation we'll look at is Graham's valuation model invented by Benjamin Graham to calculate intrinsic value. And basically what we need to plug in are these metrics here. We have our earnings per share, which is forward looking for Walgreens. We then have our growth rate projection, which if you look at analyst projections, they're essentially projecting zero growth, which in my opinion actually makes a lot of sense. When you see they're basically producing no free cash flow, how are they going to be able to grow if they can't reinvest back into the business, or they can't buy back shares or pay down debt? So once we've done that, we divide by Y, which is the current yield on AAA corporate bonds. And in this current economic environment, it is sitting pretty high at 5.2, which will drive down this valuation. Once all this has been plugged in, you can see we come to an intrinsic value of $19.72 per share, which is actually extremely close to the current trading price for this company. So when it comes to Graham's valuation, it looks like the market agrees. There is essentially zero growth being projected into the fair value for this company. Now, when we jump over to the discounted cash flow analysis, again, the idea is we should be able to value a company based on how much future free cash flow they're going to produce. So I plugged in historical data, looked at analyst projections and industry expectations, and decided on a free cash flow growth rate of 1%. Who knows, maybe that's even being a little generous, honestly, with this company, but we'll keep moving forward. I used that 1% growth rate for the future free cash flows, found the present value, added the sum of those future free cash flows, added the cash and cash equivalent, subtracted out the total debt to get the equity value, and once I divided by shares outstanding, I came to a discounted cash flow price per share of $21 even, again, extremely close to that current trading price. So again, it looks like the market is essentially pricing in around 1 to 0% growth of free cash flow with this company. Now, typically the next thing we look at is the multiples valuation, but really the only good comparable, in my opinion, for Walgreens is CVS. And really using one company isn't a good idea for the multiples valuation, so we won't be using it in this scenario. So the last valuation model we'll look at is the dividend discount model. And basically we're valuing a company based on how much they pay out in dividends and how much that dividend is increasing over time. So I plugged in the company's historical dividend payments so we can see those yearly dividend payments. and the yearly dividend growth rates. And like we already know, those dividend growth rates have really started to slow over the past few years, as we can see. And so I'm projecting 0% dividend growth for this company. So with a discount rate of 8.5%, we actually still come to a dividend discount model price per share of around $22.59. So those high dividend payments are holding up this somewhat decent share price compared to the current price. Now keep in mind, there is still a risk of a dividend cut. So for example, let's say the dividend were to get cut by around 10%. If we come over here, let's say it got cut by 10% and we'll plug in the new dividend payout, 0.432. With 0% growth after a 10% dividend cut, we could see our fair value would be sitting at around $20.33. So technically, when you look at the dividend discount model, you could argue there's around a 10% dividend cut priced into this stock right now. That's one way of looking at it. We'll go ahead and reset this back to assuming 0% dividend growth with no dividend cuts. So when we jump over to the output tab, we can see the three valuations that we use: Grams at 1972, DCF at 21 even, and dividend discount model at $22.59, giving us an intrinsic value of $21.10 per share, a little bit off of that current trading price. So with a 10% margin of safety, technically your acceptable buy price is sitting at around $19 per share, and a 20% margin of safety, $16.88. So in my opinion, I don't see any reasons I would personally want to add to this stock. There's a lot of red flags, and obviously I'm looking to buy stocks that I believe will help me achieve my long-term goal of being able to live off of dividends. So while on the surface level, it looks like Walgreens could be an attractive dividend play with a high starting dividend yield and a really nice history of dividend payments, when you dig into those financial statements, it's clear there are some big red flags when it comes to the dividend safety with this company. So there you go. Go ahead and let me know your thoughts on this company down in the comments down below. And like always, if you'd like to be able to download the spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.